8 hours ago, JD Power and Associates awarded us our 11th straight best in client service for loan origination. No one's ever achieved that before.
Welcome back to the Capital Mindset Show, guys. So today we actually have a viewer requested stock, and that stock is RKT, Rocket Companies, Inc. And basically what he wants to know is kind of what we found regarding this stock in regards to their ownership structure, some other events that have recently taken place involving it was a short interest. And then also too, just kind of our overall sentiments regarding RKT. So now, Fabio, any initial opinions kind of walking into this about RKT?
I actually have some experience getting a mortgage from Quicken Loans in the past. Mm-hmm. And it was fairly easy, the process. That's the whole point. That's the whole thing that's supposed to attract consumers to Rocket Companies and all of their different products. Is the ease of use. And so that's the business believes that it can streamline this process and make the whole lending process for consumers a lot easier. So they have a bunch of different brands. I think it's like around 16 different companies.
Subsidiaries, yes.
Yes, underneath the umbrella of Rocket Companies. And we're going to get into exactly what that entails as far as an ownership structure and a little bit of a prerequisite to that. It is perhaps one of the most complicated ownership structures on the American stock market that I've seen in recent memory. Right.
And also another thing to add too, a lot of videos that we've watched about this, they break it down very, very well, but it's more so like kind of like this high level. So what we're going to try to do is we're going to try to use dollars and just kind of really break it down in a way that like the retail investor could really actually understand what like this entire business entity consists of. So before we do that, it's important to actually know, and I'm going to share my screen here now, what we're kind of looking at here. Okay. So I'm sure that you've probably seen some other videos, et cetera, around YouTube regarding this ownership structure, let's say. But so for the sake of this example, we're going to start with Quicken Loans. This is their S1, by the way. Quicken Loans makes $90,000. Okay. And then the other subsidiaries of this specific entity here.
Awesome. I think you should use
10,000.
You should use 90 and 10. So you don't write so long.
Okay. Yeah. So yeah. All right. So this equals a total of 100. Now 100 of this belongs here. $100,000 belongs here. Now, basically with Rock Holdings Inc., they have non-voting common units that have no voting power. However, Rock Holdings Inc. owns 92% economic interest in RKT Holdings LLC. So from here, this now consists of $92,000 worth of the business profits from here. All right. And now Dan Gilbert, who's the chairman, he owns 0.05% economic interest, also non-voting, of this specific entity, RKT Holdings LLC, as well. So here, he now actually has $50. And no, this is not $50,000. This is just $50 flat. All right. And then what ends up happening here is that the Rocket Companies, Inc., which you, the public, through the Class A common stock system are buying into itself, this owns $8,000 of the economic interest here. It owns 8% of the economic interest, thus $8,000 worth of the business earnings. Now, here's where this gets interesting. So on their balance sheet, you can see 4 classes of stock, A, B, C, and D. B and C were done during the IPO, so those will be disregarded in terms of this ownership structure. Now, Class A is what you, the retail investor, are buying on. It is the Class A common stock that has a 20% voting power, because usually when companies issue capital stock, that gives you voting power in the company itself. This has a 20% voting power and 100% economic interest in Rock Companies Inc. here. So you have 100%, you are entitled to 100% of this 8,000 here. Now, Class D comes into the picture here. And what Class D gives is a substantial amount more voting power. So right here, Rock Holdings Inc. owns a 79% voting power of Rocket Companies, Inc., while Dan Gilbert has a 1% voting power.
Just to be very clear there, it doesn't give you more voting power. It's just it's 1-to-1. So A gets 1, D gets 1, and there's just more D shares than there are A shares. And when you add up all the shares together, 20% of all the A shares, sorry, all of the shares together, 20% of them are A, 80% of them are D.
So basically, if what you're seeing here confuses you, this is kind of the exact point that me and Fabio here right now would like to illustrate, is that whenever you're confronted with a business structure that confuses you, I like to walk away. Personally, I like to walk away, because if I can't make sense of what exactly I'm owning, then that might signify to me a potential red flag here in terms of this entity. So now, Fabio, what does this entity look like to you? And we've made other videos before regarding these sorts of entities.
So this entity in front of me looks exactly what we were been talking about before in our China videos. It's just a less complicated version of that, otherwise known as a variable interest entity.
So something else I also want to note too, Rock Holdings Inc., the primary shareholder is Dan Gilbert himself. So now that we kind of have that out of the way, they actually disclose on their 10Q here that they are actually operating as a variable interest entity. And so I actually think that's incredibly interesting, Fabio. And now I kind of want to pick your brain now. If you were a retail investor, that why would they be potentially doing these sorts of things, Fabio? Like, why would they be structuring themselves as a VIE and then issuing two classes of stock, et cetera? Like, what are your thoughts coming into this?
All right, so right here we can see the entity. So why does this exist? What is the purpose of the Class A? Well, the Class A is what you're buying at the end of the day. So RKT, that stock you see on the stock market, that's right here. You're buying this business, as Austin was saying. Why does this exist? Well, there's a couple of reasons. Well, Class D, when it's sold, it is converted to Class A, because you and I, we can't own Class D. Class D belongs, it's only for Rock Holdings and Dan Gilbert. So when Dan Gilbert or Rock Holdings want to sell their shares, it's converted to Class A and then it's sold into the public. All right, so let's play a game of how I can legally mess with you as a retail investor, right? I am the founder of this business and I want to play around with you a little bit. What does that entail? So let's assume a scenario where, and let's clear everything out and restart. Let's assume that the public now owns 100% of Rocket Companies, right? How much, Austin, do they get in profits?
Well, off of that initial $100,000 I put, they're only getting $8,000 or 8% of the business profits from Quicken Loans and the other subsidiaries, which is the profits of the RKT Holdings LLC entity itself.
Because as you can see here, it says here they make 100% economic interest of Rocket Companies. However, Rocket Companies only makes 8% of Rocket Holdings. Right? So at the end of the day, you can do a simple math equation. 100% times 8% is just 8%, right? 8%, that's all you're really getting, right? So you can own 100% of this and you would still only make 8%. And our Rock Holdings over here and Dan Gilbert will make the remaining percent. Give or take a little bit. If anyone hasn't noticed, they didn't even bother to round one of these. So one of these I
actually noticed that it's literally 100%, 105%.
Not 5, like, 100.05.
Yes. Well, yeah. That's 100 and point. Yeah. You're right. I meant 5%, but yeah, you're right.
And then, so
yes. Yeah. Sorry. Yeah. It's like, this is exactly what we're talking about.
Exactly what we're talking about.
You know?
So yeah. Even though it says here, right here, 0% economic interest, right? Both Dan Gilbert and Rock Holdings have 0 economic interest of Rocket Companies. They have the voting power in conjunction with their ownership of Class D common stock. But Class D common stock is completely separate as an agreement. So the common stock has only a relation to Rocket Companies. It has nothing to do with this other agreement over here. So this agreement with the non-voting common units right here, has everything to do with just Rocket Holdings. That's a separate agreement, okay? So that's why even if you owned 100% of Rocket companies, you would still only be entitled to 8% of the business's profits. They don't really care. All right, so now what are some of the implications of this? This actually brings a lot of different implications. So one thing that Rock Holdings and Dan Gilbert, they can issue new shares and dilute you, and it will not affect their portion of the business's profits. It would not matter to them. All they would be doing is giving up some voting power of Rocket companies, which is what you're buying when you buy RKT. They would not be losing any economic interest in the actual companies. Okay. Now let's say Rock Holdings wants to sell its shares and take some profits with its Class D shares, right? If it does this, right, you get a new amount of Class A common stock, and they are basically cashing out, right? They're selling voting power, but they're not selling economic interest. The economic interest for them doesn't change. They're basically selling shares and not diluting themselves as a portion of how much they are owed of the profits, because they are keeping that 92%. Okay. So I've kind of already went about like 3 ways that they can legally mess with you right here. There's nothing illegal about what they're doing here. This is a variable interest entity. And it, as I've said in previous videos, when I was discussing China, this is a simple version of what the Chinese companies are. And even in this entity, just because it's American, it's given a little bit more scrutiny. Now, I'll kind of show a little bit right now about the stock's performance over time right here. Let's actually go here. So this thing IPO'd originally around $24 in August 7, 2020. It did this weird little merger thing. Now, in the 5-year, it doesn't show it, but right here on the 1 year, we can see the spike actually. And this spike was because of a short squeeze. And actually, we'll go ahead and play a video right now of kind of the environment that and the sentiment that was going on, exemplifying the short squeeze phenomena of Rocket.
Keep an eye on this morning.
Yeah, well, it's 38% short, Carl.
Jim?
You know, when the people see that, they think you can bust the sellers. Now, I have been a huge fan of Jay Farner and Dan Gilbert and have had them on, and frankly don't understand why the stock didn't react to what was a very good quarter, where they basically laid out a story which just said, we can show you how when rates go up.
So as you can see from that video, they were all talking about how great this company is, how this short squeeze was coming, how underneath this complicated business structure, it's not really a problem. Now, since then, it has actually gone down. Okay, so let's actually discuss the problem with the short squeeze thesis, which is actually a big problem for retail investors, because at the time, right, I have this pulled up for a reason. At the time, it didn't say the short interest was this low. All right, so this is the actual and accurate short interest of the current stock Rock RKT.
So Fabio, can you kind of walk us through why there was such a craze in regards to the short interest itself, and kind of break down that entire situation for some of our audience out there to kind of gain like a better understanding?
Yeah.
And then also too, if you have any warnings for such things as well, if you could kind of give those as well in terms of making sure that you do further due diligence and et cetera.
Yeah, so it's difficult because normally I would say that don't trust any website or anything like that, just like right off the bat. So I'm using Seeking Alpha here. Seeking Alpha is pretty good at showing this kind of information right off the bat, and short interest is usually up there. It's more or less accurate, but that was not the case 6 months ago. I can tell you right now it was around 40%, and I have the screenshot here from a Bloomberg terminal right here, showcasing Rocket companies at a short interest float, percent float of 45%. And you can see here the date, the 2nd of March, 2021. And the date can be confirmed in 2 places. I can move us right here, the 2nd of March, right here. So what does this mean? So basically what they thought, if anyone was kind of paying attention to the markets, they were thinking, oh, wait, this is a GameStop. play, you know, the short squeeze. We're going to squeeze out the shorts, and basically shorting is you borrowing shares, and so you will have to buy back the shares in the future. So if you can force a share price up, they can get their shares called back, and then it forces them to be buyers. So you can get an exorbitant run up. So you had actually the Reddit crowd coming in here, and for a period of time, well, I don't know if it exactly was the Reddit crowd, but it was a lot of retail investors coming in here and pumping up the stock to over 100% in just a couple of days. And this wasn't actually the case of a short squeeze. It was actually a very poorly researched for in terms of like making sure that the short float was a short float, and that has everything to do with the confusion of the actual entity right here. Because if we go back and we remember the Class A shares, they're only actually 20% of the shares outstanding. So if you take actually all the Class A shares on the 10K and you add them together, it equals to about exactly 20% of the total shares outstanding. And that was being calculated just only on those shares. So it looked really big, the short float, but it wasn't when you consider the entire company. And I think the market cap, let's actually pull up the model
Fabio,
now.
if you could summarize what short float means for maybe some of our audience who might not know what that is and its implications and how it really played into this as well.
Yeah, so the short float basically implies the amount of shares that have been borrowed from the company and then sold, right? So borrowed, not from the company, sorry. They've been borrowed from the market and then sold immediately. And what they have to do eventually is return a share. So if the share goes down in price, they can buy back the shares at this lower price and pocket the difference from what they originally sold it. Okay, so if a share is $10 right now, and I think it's going to go down, and what I'll do is I'll borrow the share from you, Austin, and I'll sell it on the open market, pocket the $10, not entirely pocketed. It gets, stored in an escrow account somewhere or in an account somewhere. And then later down the road, it goes down to $5. I have to buy the shares back for $5, and then I give you the share back and I pocket the difference. Right. That's what I end up keeping. So actually right here, I'm going to make a point here. So you see this market cap, it's 2.3 billion. That original short interest was predicated on that market cap because the systems weren't properly adequated for the amount of shares that were actually on the market or the total market capitalization. So the model right now is calculating the market cap actually accurately based on the Class A shares. That's the market cap of Class A. If we go back to Seeking Alpha real quick, we can see the market cap is 32 billion. A far cry from 2 billion, right? So very different numbers. The model is right because this is Class A, and actually everything in this model has been accounted for based on the actual that 8% economic interest for the Class A shareholders. Now, if you're looking at the model and you're saying, what is that? Is that a 100% discount rate? Yes.
Yes,
that is.
With a negative 59% share dilution.
Oh, no. That's a negative 0.5. 0.5%.
Yes.
Yeah, there's a little dot
sorry about that. That happens sometimes when I'm looking at these percentages.
So what we can see here is even in some forms of decay, at a 5% decay in the cash flows, the model is telling me just straight off the bat that it's more or less a buy, which is quite interesting. We don't really need this, and actually it is at a good standing in terms of the Altman Z-score, but even though it's technically used for manufacturing firms, but it's good to use here and there. What do you think about this, Austin? You think the model is just broken?
Yes, Fabio, I think your model is broken.
Yeah. So this perhaps is one of the more challenging parts of finance. It's kind of like you can automate a lot of things, but it's like, it's both an art and a science. And so what the model lacks is a lot of nuance, right? So the nuance that we've been discussing with you today is a lot of the risks associated with the entity itself, the way it's structured. What does that entail? What do you really own? How many times, the actual controlling interest of the company mess with you, for not to use a bad word, but they can mess with you, right? The model does not actually account for that. We can try to account for that with a really high discount rate, but if we actually go through, for example, some of the cash flows, statement of cash flows, and we can kind of play around with what's going on here. We see on a GAAP net income basis, they're losing $3 billion this year so far, but what is their cash from operations? It's a positive $3 billion, right? So, but look at this. This is what's kind of interesting. So I think the market basically is seeing something. The model is calculating under these terms, right? Under 2.7 billion. However, look what this is telling me. This is telling me an interesting story. And by the way, this is live. So we're just kind of discovering this live, right?
Yeah. Oh yeah.
We are figuring this out in real time. So you can kind of get an idea of how we're thinking about this. So the CapEx is really low, but now this is painting a fuller picture. Their GAAP net income is mostly positive all the time, except for something that's going on here in 2021. But the cash from operations, it's negative in 2019, negative in 2020. They went public in 2020, and all of a sudden it's positive. So I have to assume that this continues. The market could be thinking that it's actually going to decrease tremendously from here. Maybe even go negative again. So maybe it's not that the model is necessarily wrong. It's that the inputs are not properly accounted for.
Yeah, and it's really interesting kind of taking a look at that too. It's like a lot of losses on sales of assets, Fabio, and they're like significant numbers too. And just kind of taking a look at that, when I see something like that, kind of a story that's a little bit all over the place, such and such, that's kind of another reason for me where I kind of take a step back and I'm like, wait a second, like before I do any further due diligence, I want to make sure that like what I'm looking at is at least consistent with the overall message that I'm kind of receiving from analyzing this stock investment itself. And now something that's kind of interesting, everything that Fabio is going over, you can automate so much when it comes to investing. You can automate ratios, you can automate a discounted cash flow model, all this, but what you can't automate is the human touch that really goes into these sorts of things, that really goes into pricing a discount rate, that really goes into creating a couple of growth rates, that really goes into a set of assumptions that you're kind of arriving at when you're trying to value a stock using a discounted cash flow model. And that's really the beauty of like when you start to study accounting, when you start to study finance, when you start to study economics, and you start to gain an understanding of these elements and how they all interwork together, then you start to be able to piece together your thoughts start to become focus, and where like you can kind of begin to make these assumptions yourself and kind of be like, okay, I'm assuming X, Y, and Z is going to happen. If I'm seeing A, B, and C has happened, I'm going to assume X, Y, and Z has happened. And that's honestly really for me, and I could probably say Fabio too, that's really where our love of investing truly comes from. Wouldn't you say, Fabio?
Oh yeah, 100%. Yes, exactly.
Yeah.
So with all of that being said though, Austin, what are your final closing thoughts on this company? Would you be actually interested in adding this to your portfolio? If not, what are the risks that you see?
And also let us know if you would like us to make a part 2 regarding this company, where I go pretty much step by step into non-controlling interest and kind of break that down, as well as what non-controlling interest is and how that specifically relates to Rocket. And to kind of address your comment, Fabio, about my closing thoughts, simply because of the business structure itself, that is enough of a red flag to completely deter me from this investment, Fabio. If I'm being completely honest, I'm not really entirely overly optimistic about the financials, about anything else, because the business structure itself deprives me of the profits of the business in essence. Would that be correct, or is that an incorrect thought?
It is misleading to think that you are entitled to the profits, and it is misleading to think that owning the entirety of the company entitles you to the profits. You are right. Yes.
Yes. So then what are your closing thoughts kind of looking at this, Fabio?
So this is an investment that is entirely out of your hands, entirely out of anyone else's hands. It is entirely in the hands of Dan Gilbert. the founder, or not, maybe not, I don't know if he's
Chairman.
exactly the founder, but he's the
Yeah.
chairman. For sure, he's the chairman. And he will control this entire business through either directly or through his other holdings company. He will have basically control over the economic interests. And no matter how much capital you put in, there's so many ways that you can be diluted as a shareholder. So for example, if he continues to issue new Class A common stock, that's not diluting him. His economic interest changes nothing at all, but yours actually does. And actually, I forgot to mention that. That was the fourth way, that if he creates new Class A common stock, okay, or the company creates new Class A common stock, nothing on his end is diluted because his economic interest is secured. However, yours is. You will be diluted. You will get less of the pie. He actually won't care at all if he dilutes you, right? If he creates new Class A common shares, not at all. He will maintain his 92.05% economic interest. So with that being said, for me personally, even though it kind of looks silly that at 100% discount rate, it looks like it's a buy, there's a lot of nuances that are lacking here. And it's actually, as Howard Marks would say, it is too good to be true. There are reasons why it looks so cheap. Okay. It looks really cheap. There's no question about it.
100% discount rate, Fabio.
Let's take a look at that PE real quick. A 6 PE on a free cash flow basis, less than 1, right? That seems too good to be true, right? The market is trying to tell you something, right? You can find opportunities when the market's not looking at something, but those are difficult, right? Investing's not that easy as people sometimes like to make it out. And even on Seeking Alpha right here, a forward PE, like they like to use forward PE of 7.74, right? Looks really cheap. To the retail investor who's not familiar with these things or doesn't do the further research that is sometimes necessary for these complicated entities, they're going to get tricked, unfortunately.
Doesn't have the knowledge for it either.
Or the time,
Yes.
It takes a lot of time to go through some of these documents. It's a lot of time and energy to sift through these things and really digest it. And maybe you don't have a university background in accounting or finance, and you didn't have someone to mentor you who could teach you, okay, this is how you do it. Well, hopefully that's what this channel is kind of helping you do, right? We're showing you what it is we found and how we found it, and some of the processes as which you can think about risk, because risk is essentially uncertainty. There's a lot here. And even though when we plug it in the fancy schmancy model, it says it's a buy, we don't actually think it's a buy, because with the nuances that come with accounting, we're kind of like, there's more to the story than meets the eye, right? So there'll be an article on our website going into a little more detail, and we'll actually go through over the macro that we didn't cover here, because I think in the video we're trying to just say, well, these are the risks that we found, and this is where we'll stop. We won't really move forward with this investment. But if you're curious about other mortgage companies, we'll add a little section about like kind of the macro risks that may be involved in other mortgage industries, mortgage companies of the mortgage industry. And with that being said, let us know if you want us to do any other mortgage companies. I have a little bit of experience in the mortgage field myself from my youth, so I have a little bit of understanding as to how these business models work. But with that being said, if you guys have any other requests, you guys can take advantage that we're still kind of a small channel and that we're probably going to get to your requests pretty quickly. So leave a comment down below, and and we'll get right to it. All right. Thank you. And don't forget to subscribe. And if you like the video, please feel free to actually like on the button down there. It actually helps our channel grow. And if, again, there's any form of like discussion you want to add, Austin, towards the end.
So please also feel free to share this video too, and because that also helps us grow as well. And we thank you so much for coming here today. This was a viewer request, and we just thank you all so much for subscribing to our channel and just giving us this ability to be able to do this. And so this concludes our video today of RKT, our analysis of the business structure of RKT. If you've liked what you've seen here today, please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. As always, Fabio and I are not licensed financial advisors. Please do your own research, and this is for entertainment purposes only. Thank you and take care.